You're getting exclusive research here. If it helps, smash like, share it, subscribe, and ring that bell.
Here's something that might make you scratch your head. Some of the biggest, smartest companies on the planet seem to be working against themselves. They're spending billions of dollars buying back their own stock, only to turn right around and create new shares. It sounds like a total paradox, right? Well, today we're going to unravel this whole financial puzzle and figure out what is really going on. And we're not talking about some small-time companies here. Nope. We're talking about the absolute titans of the NASDAQ 100. You know all these names: Apple, Amazon, Microsoft, Nvidia, Tesla. And get this, every single one of them is playing this high-stakes game. Understanding why they do it reveals this fascinating tension right at the heart of modern business. So here's our game plan. We'll peek inside the NASDAQ 100 to see the puzzle. Then we'll dive into 2 case studies, break down the core ideas of buybacks and employee stock plans, and finally, unpack what this trade-off really means for investors like you. All right, let's kick things off and frame the central mystery that's playing out inside the NASDAQ 100. It really is a head-scratcher when you think about it. A company uses its hard-earned cash to buy back shares from the market, which should make every remaining share a little more valuable. But then it turns around and issues brand new shares, usually for its employees. It really looks like one hand is just completely undoing what the other hand just did. So why on earth would they do that? That's the billion-dollar question we're here to answer. To really make this concrete, let's zoom in on 2 very different companies that put this paradox right under the microscope: Zoom and Taboola. First up, Zoom. This recent headline from Simply Wall Street just gets straight to the point. They've filed for a potential $1.3 billion stock issuance just for their employees. That is a massive, massive number, and it represents one side of this financial tug-of-war. And it's not just a giant like Zoom. Check out this headline for Taboola, a much younger company. They're also using these so-called employee stock plans, and they're doing it at a really pivotal moment right as they've become profitable. It's basically the same playbook, which really makes you wonder, what is the master plan here? Okay, so let's break down the 2 opposing forces in this financial tug-of-war. What are we actually talking about here? So first, what in the world is an ESOP? It just stands for Employee Stock Ownership Plan. And in plain English, it's a way to give employees a piece of the action. You can almost think of it like golden handcuffs. It's a super powerful tool to attract, motivate, and keep the best talent you need to win. This slide just lays out the core conflict perfectly. On the left, you've got stock buybacks. The goal? Make shareholders happy. The action? The company buys its own shares to shrink the supply. The effect? Every share left represents a bigger slice of the profit pie. Now, on the right, you have ESOPs. The goal there? Reward your employees. The action? The company creates new shares out of thin air. And the effect? It increases the number of shares. This is called dilution, and it's the exact polar opposite of a buyback. All right, with those ideas in our back pocket, let's dive into our first case study, Zoom's multi-billion-dollar balancing act. So on one side of the scale, get this, Zoom has recently spent a jaw-dropping $2.7 billion buying back its own stock. I mean, that is a massive signal to investors that they are serious about creating shareholder value. But then, at the very same time, they're getting ready to issue up to $1.31 billion worth of new stock for their employees. They are literally pulling on both ends of the rope at once. So here's the gamble. Right now, Zoom's earnings have been huge, which gives them the cash to do both things. They can afford to buy back shares to cancel out the new shares they're giving employees. But here's the risk. Their earnings are actually forecast to go down, and they're facing monster competition. So what happens if growth stalls? Well, suddenly creating all those new shares could become a much, much bigger problem. It's a real high-wire act. Now, let's switch gears and look at Taboola, because it shows the exact same strategy in motion, but for a totally different reason. Taboola's story is all about hitting a turning point. After losing money for a year, they finally flipped to being profitable. And for a company at this stage, every single dollar counts. How they spend their money is absolutely critical. So what's one of their first big moves as a newly profitable company? You guessed it. They also file for an employee stock ownership plan. Now, the scale is way smaller than Zoom's, obviously, but the principle is identical. To get to that next level of growth, they know they have to keep their key people motivated, and stock is the currency to do it, even if it means diluting their shares a bit. So, what does all this mean for an investor? Well, at the end of the day, it all boils down to a classic trade-off: growth versus returns. This table really puts the dilemma in black and white. Imagine you're the CEO. You've got shareholders on one side, and they're demanding you buy back stock to boost their returns now. But on the other side, you've got the entire future of your company, which depends on attracting and keeping the brilliant people who will create the next big thing. And to get them, you have to offer them stock. It is a constant strategic battle. So here's the key takeaway. This isn't a contradiction, and it's not a mistake. It's a strategy. These companies are trying to walk an incredibly fine line. It's a delicate balancing act between keeping today's investors happy while at the same time fueling the innovation that will create value for everyone tomorrow. And this all leaves us with the one critical question you should be asking as an investor, especially now, as the war for talent in fields like AI gets more and more intense. When push comes to shove, who are these companies going to prioritize? Today's shareholders or tomorrow's innovators? The answer to that question is going to define the next decade of tech.